What's shaking, crypto fam? Get ready for a lightning-fast update because the market is moving at warp speed and you need to know what's happening now. We've got massive liquidations shaking up the big players, a major digital asset making history at an unprecedented pace, and a deep dive into a future financial challenge that could redefine everything. Plus, we're breaking down why one asset is surging ahead of another in this wild economy. Stick around because you won't want to miss a single second of this intel. Let's dive in. First up, the crypto world is reeling from a massive wave of liquidations, wiping out billions in leveraged bets as major coins take a nosedive. We're talking about significant price drops and a surge in volatility that's catching many off guard. Get ready to understand the ripple effects of this massive market shakeup. Then, we're celebrating a groundbreaking achievement as a leading digital asset has reached a staggering market capitalization faster than any titan of industry or even Bitcoin itself. This isn't just a number. It signifies a fundamental shift in the digital asset landscape and what it means for the future of finance. And finally, we're looking ahead to a potential future economic storm brewing on the horizon, a debt wall that could impact everything from traditional markets to our beloved crypto. We'll break down the cycles, the risks, and what it could all mean for Bitcoin and beyond. Don't go anywhere. Hit that like, subscribe, and ring that bell so you don't miss any of these critical updates. Markets in turmoil, billions wiped out amidst crypto chaos. The cryptocurrency market is currently experiencing a seismic shift, with over $900 million in leveraged positions being liquidated in a single day. This dramatic downturn has seen major digital assets like Bitcoin and Ethereum experience significant price drops, sending shockwaves through the investor community. The catalyst for this volatility appears to be a combination of macroeconomic uncertainty and substantial selling pressure from a large whale investor, who offloaded a massive 24,000 Bitcoin, valued at approximately $2.7 billion. This single transaction alone contributed to Bitcoin's price falling below the critical $110,000 mark for the first time since early July, a level that had previously provided significant support. Technically, Bitcoin's momentum has turned bearish, with its price now trading below key indicators such as the 100-day Simple Moving Average, SMA, and the Ichimoku Cloud. This bearish configuration echoes patterns seen in earlier sell-offs, signaling potential for further downward pressure if key resistance levels are not reclaimed. Analysts are closely watching support levels around $105,390 and the 200-day SMA at $100,928, while resistance stands at $111,592 and $117,416. A failure to break back above these resistance points could confirm a sustained bearish trend in the short to medium term. The volatility has not spared other major cryptocurrencies. Dogecoin saw a decline of over 10%, falling to 0.208, while Solana experienced an 8.5% drop, settling at $186 after reaching a 6-month high. XRP also felt the pressure, declining nearly 6% to $2.85. Notably, while Bitcoin shows bearish technicals, Ethereum and Solana are still trading above their respective 100-day SMAs, suggesting they might be in relatively stronger technical positions compared to BTC. However, the overall market sentiment remains cautious. The liquidation data reveals that Ethereum traders bore the brunt of the losses, with approximately $320 million in ETH positions being liquidated, followed by Bitcoin at around $210 million. Crucially, over $817 million of the total liquidations were tied to long positions, indicating that traders who were betting on prices to rise experienced the most significant losses. This surge in liquidations has been accompanied by a sharp increase in implied volatility for both Bitcoin and Ethereum, with Ethereum's daily volatility spiking from 41% to an alarming 70%, underscoring the heightened risk and uncertainty in the current market environment. The broader macroeconomic backdrop continues to be a primary driver of market sentiment. Investors are keenly awaiting key U.S. economic data releases, including the personal consumption, expenditures, PCE, report, and consumer confidence indices. The outcomes of these reports will heavily influence the Federal Reserve's upcoming decisions on interest rates. Any indication of delayed rate cuts could prolong the period of market uncertainty, particularly for assets perceived as higher risk, such as cryptocurrencies. Analysts are also observing a defensive shift in market positioning, with implied volatility diverging between Bitcoin and Ethereum, suggesting a cautious approach among traders anticipating potential market shifts. The community reaction has been a mix of concern and a call for caution, with many experienced traders emphasizing the importance of risk management in such a volatile period. Social media discussions highlight the impact of macroeconomic news on crypto prices and the ongoing debate about whether this is a temporary correction or the start of a more prolonged downturn. But as the market grapples with these immediate shocks, a much larger picture is beginning to emerge. Could these current events be a prelude to a significant long-term shift in the digital asset hierarchy? Ethereum's historic rise, outpacing Bitcoin and industry giants. Ethereum has just etched its name in financial history, achieving a market capitalization of $500 billion at an unprecedented speed, surpassing not only major corporations, but also Bitcoin's own past bullish cycles. This remarkable feat is built upon a recent surge that saw ETH reach a record high of $4,946, a climb fueled by aggressive accumulation from institutional investors and significant whale activity. This influx of capital indicates a notable shift, with substantial funds being reallocated from Bitcoin to Ethereum, signaling a potential reevaluation of asset hierarchy within the digital currency space. The adoption of Ethereum extends beyond speculative trading, with publicly listed companies, such as SharpLink Gaming, actively increasing their ETH holdings as a strategic reserve asset. This institutional embrace elevates Ethereum beyond its altcoin status, positioning it as a fundamental component of modern financial strategies. Ethereum's market dominance has climbed to 14.98%, its highest point since September 2024, encroaching on Bitcoin's territory, which has seen its dominance fall to 58.2%. This trend reflects a broader market sentiment favoring Ethereum's inherent versatility, serving as the technological backbone for decentralized finance, DeFi, non-fungible tokens, NFTs, and various tokenization solutions, rather than Bitcoin's primary role as a store of value. Despite the impressive rally, certain technical indicators suggest a need for caution. Glassnode data indicates that Ethereum's market value to realized value, MVRV ratio, has reached 2.15. This metric, which compares the current market capitalization to the average cost basis of all circulating tokens, shows that, on average, investors are holding unrealized gains exceeding double their initial investment. Historically, similar MVRV levels, observed at the end of 2020 and early 2024, have preceded periods of heightened volatility and significant profit-taking events. The risk of such volatility is amplified by the record-low reserves of ETH on centralized exchanges, currently standing at 18.3 million units. With a diminished supply available on exchanges, even smaller buy or sell orders can have a more pronounced impact on price, increasing the likelihood of sharp short-term price movements. This ascent of Ethereum represents more than just a speculative surge. It signifies a fundamental evolution within the cryptocurrency ecosystem. While Bitcoin remains largely positioned as digital gold or a store of value, Ethereum is establishing itself as the essential infrastructure for a burgeoning financial ecosystem. The widespread applications in DeFi, tokenization, NFTs, and the development of Layer 2 scaling solutions provide tangible utility that underpins its current valuation. This dynamic is prompting a recalibration of investment strategies, with institutions increasingly seeking assets that not only offer potential as a store of value, but also generate returns within a rapidly expanding and innovative ecosystem. The community's reaction has been overwhelmingly positive, with many celebrating this milestone as validation of Ethereum's technological superiority and future potential. Analysts point to the increasing utility and adoption of the Ethereum network as key drivers, suggesting that the $500 billion valuation might just be the beginning of a broader transformation, where Ethereum solidifies its position as the foundational layer for decentralized finance. While Ethereum's rapid ascent is capturing headlines, a different kind of challenge is quietly building in the background. Could a massive wave of global debt refinancing create a perfect storm for risk assets, including Bitcoin? Ethereum's market cap milestone, a new era for digital assets. Ethereum has achieved a monumental milestone, crossing the $500 billion market capitalization threshold with a speed that eclipses even the most prominent global companies and Bitcoin's peak performances. This historic achievement is a testament to the growing institutional adoption and significant accumulation by whale investors, who have been reallocating capital from Bitcoin to Ethereum. This shift signifies a profound change in the digital asset hierarchy, highlighting investor preference for Ethereum's multifaceted utility. The impact of this growth is evident in the broader market. Ethereum's market dominance has reached 14.98%, its highest point since September 2024, effectively challenging Bitcoin's long-held supremacy, which has seen its dominance recede to 58.2%. This trend underscores a fundamental market mutation. Investors are increasingly valuing Ethereum's versatility as the engine for DeFi, NFTs, and tokenization solutions, moving beyond Bitcoin's primary function as a store of value. This broader adoption is further solidified by listed companies, such as SharpLink Gaming, incorporating ETH into their balance sheets as a strategic reserve asset, treating cryptocurrency as a legitimate financial instrument. However, this rapid ascent is accompanied by signals that warrant caution. According to Glassnode, Ethereum's market value to realized value, MVRV, ratio has hit 2.15. This indicator, which compares the current market value to the average acquisition cost of circulating tokens, reveals that investors are holding average unrealized gains that more than double their initial investment. Such high MVRV ratios have historically preceded periods of significant volatility and profit-taking, as seen in late 2020 and early 2024. The risk is further amplified by the record-low reserves of ETH on centralized exchanges, currently at 18.3 million units. This scarcity means that even moderate trading volumes can cause substantial price fluctuations, increasing the likelihood of short-term volatility. The significance of Ethereum's rise goes beyond speculative trading. It represents a fundamental transition in the crypto landscape. Unlike Bitcoin, which is largely perceived as a digital store of value, Ethereum is emerging as the foundational infrastructure for a dynamic financial ecosystem. The continuous development and adoption of DeFi, tokenization platforms, NFTs, and Layer 2 solutions provide tangible use cases that justify its impressive valuation. This evolution is reshaping investment strategies, with institutions now seeking not just a hedge against inflation, but an active participant in a rapidly expanding digital economy. Community sentiment reflects a strong belief in Ethereum's technological advancements and its potential to revolutionize finance. Analysts attribute this growth to the network's expanding utility and the increasing integration of blockchain technology into mainstream financial applications. The $500 billion market cap is viewed by many as a stepping stone towards a future where Ethereum plays an even more central role in the global financial system. As Ethereum solidifies its position, a critical long-term challenge is looming in the traditional financial world. Could a massive refinancing wave in 2026 create a significant liquidity crunch that impacts risk assets like Bitcoin? 2026 debt wall, a looming challenge for Bitcoin and global markets. An enormous debt wall is set to mature across advanced economies in 2026, presenting a significant refinancing challenge that could drain global liquidity and exert downward pressure on risk-on assets, including Bitcoin. This looming challenge arises from approximately $33 trillion in debt obligations that will come due in that year, a figure nearly 20% higher than previous years and substantially exceeding annual capital expenditures. Refinancing such a massive volume of debt at current higher interest rates could strain governments and corporations, particularly those with weaker credit profiles, potentially leading to a squeeze in market liquidity. This situation is projected to coincide with the latter stages of Bitcoin's traditional 4-year cycle, which historically includes a bear market phase. While some experts argue that the standard Bitcoin cycle is becoming less relevant due to factors like the diminishing supply of unmined Bitcoin and the increasing influence of macroeconomic and regulatory forces, the interplay with traditional finance, TradFi cycles, is becoming more pronounced. The peak in global liquidity is anticipated by late 2025, according to various economic models, a point often preceding periods of market tightening. If liquidity begins to contract in 2026, as suggested by these cycles, Bitcoin could face a deepening bear market, especially if refinancing demands absorb available capital. Global debt has surged to approximately $315 trillion as of Q1 2024. With average debt maturities around 7 years, roughly $50 trillion needs to be rolled over annually. The 2026 maturity wall represents a significant concentration of this refinancing activity. The Financial Times highlights that refinancing these volumes at higher rates, even with potential Federal Reserve rate cuts later this year, will keep borrowing costs elevated compared to the 2020-2021 period when much of this debt was issued. This could lead to increased capital costs, widening credit spreads, and a higher demand for risk premiums from investors, thereby pressuring the valuations of risk-on assets. While global liquidity has shown robust growth, reaching $95 trillion across major central banks and $182.8 trillion by a broader measure, this liquidity is also subject to cyclical patterns. Economist Michael Howell's Global Liquidity Index points to a potential peak by late 2025, suggesting a subsequent tightening phase. U.S. bank reserves, though currently abundant at $3.2 trillion, are also subject to central bank policies aimed at reducing them. If these liquidity cycles tighten as projected, Bitcoin would likely experience negative repercussions, potentially exacerbating any ongoing bear market. Conversely, if debt pressures force central banks to inject more liquidity, it could provide a tailwind for Bitcoin. Longer-term market cycles also play a role. Analysis of secular bull markets since World War II suggests they typically last 18 to 19 years, with the current cycle, beginning in 2009, potentially extending to 2028. This longer-term perspective might imply a milder bear market in 2026, followed by a recovery in 2027 and 2028, which also aligns with a Bitcoin halving event. Ultimately, Bitcoin's future trajectory will be shaped by a complex interplay of debt cycles, liquidity trends, policy decisions, technological innovation, and investor sentiment, rather than solely by its own internal cycles. Market observers and crypto experts are debating whether the traditional 4-year Bitcoin halving cycle still holds as much sway, given the increasing integration with global financial markets and the impact of macroeconomics. The consensus appears to be that understanding these broader TradFi rhythms is becoming as crucial as tracking Bitcoin's halving schedule. So, while the macro picture presents potential challenges, the crypto space itself is witnessing a remarkable shift in dominance. Are we seeing a fundamental change in which digital asset is leading the pack? And that's your crypto breakdown. Bitcoin and Ethereum saw major liquidations. Ethereum hit a historic $500 billion market cap faster than anyone, and we've eyed a potential 2026 debt wall that could shake markets. Don't miss out on any future updates. Smash that like button, subscribe to Bitcoin Bulletin, and ring the notification bell. Follow us on all social platforms for more insights. We'll see you next time.